Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is brought to you by 10 East. Longtime listeners know I've invested in private markets quite a bit myself, but with access to these markets broadening, it can be hard to know where to find vetted, high-quality offerings. That's where 10 East comes in. 10 East is a platform where qualified investors can co-invest on a deal-by-deal basis across private equity, private credit, real estate, venture, and other one-off opportunities typically unavailable through traditional channels. They're founded and led by Michael LaFell, who spent his early career building Davidson Kempner, and who invest material personal capital in every offering they bring to the platform, aligning interests with 10 East members who co-invest at their discretion. Join numerous founders, executives, and portfolio managers from leading investment firms who use 10 East to diversify their personal portfolios. Inquire for membership at 10east.co. That's the number 10east.co. Welcome back, everybody. We got an awesome episode today. Our guest is Lori Calvasina, head of U.S. equity strategy at RBC. She was also just named to Barron's 100 most influential women in U.S. finance and a graduate of Wahoo University of Virginia. We're going to get into everything going on with U.S. stocks today, and she's going to tell us exactly where the S&P is going to finish this year. Lori, welcome to the show.
Thanks for having me. Wahoo.
I want to start with something you've written about, which is we're still in the early days of the post-COVID era of investing. What do you mean by that?
So this is maybe where I get a little bit more philosophical when we do the stock market work, but I started back in equity strategy at Citi back in 2000. All right, and I joke that I got my job in March of 2000, right as the tech bubble was peaking. They were giving out jobs to political science majors. That's how I got my start, but it was this really important mile marker. I didn't witness the melt up, but I did witness the meltdown. And I've thought a lot about that period. If you also think about the GFC, the financial crisis, I moved from Citi over to Credit Suisse then, covering small caps at the time. And I remember when we got to the GFC, it felt like everything I learned over the past decade changed. We were suddenly in this really wacky monetary policy environment. We had seen the market leadership just really shift. So as we've come out of COVID, we've come out of this 2020, 2021 period, and a lot of my work, I've just thought about, do prior relationships still exist? Should we still be using the same post-GFC playbook for investing, whether that's coming up with things like valuation forecasts, looking at what drives sectors? And I remember really seeing around the GFC period, there were certain indicators that used to drive sector performance that stopped driving sector performance in the post-GFC period. And that was always just a lesson to me that just because a relationship has existed for 5 years, for 10 years, maybe even 20 years, is it necessarily going to endure going forward? That premise is something that's really formed a lot of what we've thought about in the last year or so, a lot of what we've talked about. And where it really hits home is thinking about, one, the valuation discussion. What kind of multiple does the market deserve to trade at? But also just conversations about the resilience of the economy and why it's constantly surprising to the upside and why we frankly haven't seen, sort of a double dip recession that a lot of people have been looking for.
What indicators do you track and how do you gauge sentiment today here in 2024?
Sentiment is something we always keep an eye on. Sometimes it matters more than others. It's been one of the better stars by which to navigate the equity market skies over the past year and a half. And I would say the sentiment indicator we're really focused on right now is the weekly AAII survey. And this is something that's really widely followed on the street. I remember learning about these kinds of indicators back in my early strategy days over at Citi. What we look at is the net bull. So not just whether you're bullish or bearish, but what's the balance between the two and how stretched is it? We also do back testing to see how worried should we be about different levels. And what's been really interesting over the past year or so is that when you hit the one standard deviation mark, so you're one standard deviation above the long-term average, and that's around, I think, like 22% right now in terms of net bullishness, we have seen some pretty significant pullbacks occur. So if you think about the one that happened last fall when interest rates were melting up and there was, all this fear in the market that the Fed was never going to be able to stop hiking rates and that was going to cause a big recession, we actually saw AAII net bulls, I think in late July, went up to that 1 standard deviation mark. Then we saw the big 10% retrenchment in the market. We get to Halloween. That indicator had gone down to 1 standard deviation below the long-term average. And then we had that fierce rally in November and December, and it goes right back up to 1 standard deviation again in late December. And it sort of hovered there for a while, didn't really break above it too much. And then we got that 5.5% drawdown that really covered early 2Q. As we're talking here today, we're not quite back up to that 1 standard deviation mark, but we've started to kind of melt up again as we've gotten more optimism about Fed cuts coming back into the picture. And so we really try to look at that data, marry it up with what we're hearing. And what I'm really seeing is that the Fed sentiment is just oscillating like a pendulum. It is just going back and forth, +1, -1, +1, -1. And it's got a lot of investors, I would say, extremely frustrated. It's fascinating and somewhat concerning to see how quickly the sentiment can change. And often, I think, frankly, some investors are mishearing some of the things the Fed's been saying and then kind of running too far in one particular direction. And then we stop and take a breath and run back in the other direction. And so investors talk a lot about whiplash, and we can really just see evidence of that in this data, and we can hear it in the conversations as well.
Let's dive into valuations. What are the key variables you guys look at today that are influencing where the market should be valued at?
Back in the day, I think it was really when I was transitioning to be a small cap strategist back at Citi, I came up with this concept of drivers. And I don't really use that acronym anymore, but it was just sort of based on this idea that there are multiple things that drive markets. And if you think there's one magic model that's always going to work, you're kind of out to lunch. The R was revisions in earnings, the I was investor sentiment, and the V was valuation. And I know there are a lot of haters of valuation, the idea that doesn't necessarily give you predictability. I think you just really have to know its place. It's one of many things that can inform a decision, and it matters sometimes, it doesn't always matter. I think the debate I have gotten sucked into over the past year and a half, and it's one that a lot of my clients talk to me about, is what kind of multiple does the market deserve to trade at? The word deserve is interesting in and of itself. I don't know that anything is deserved or not deserved when it comes to equity markets. But if you sort of think about what kind of multiple makes sense, I found that there's sort of this tendency among a lot of people. And I think it's a function of when a lot of people came into the business, to be honest. There's post-GFC models going around. And that was really a wacky monetary policy environment. We had very weak GDP. We had very low inflation. We had very low interest rates. But there are a lot of people who are just looking at forward PE multiples based on analyst earnings, which are subject to a lot of variation in and of themselves. They generally start out too high and come down. But a forward PE that's based on forward estimates, you can do the math. You can run correlations where there's some pretty decent correlations with 10-year treasury yields if you start in, say, 2010 or 2011 or 2012. And I found at the time this debate was coming up, a lot of people were like, well, the bond market is telling us, based on where the 10-year treasury yield is, that the PE needs to be 15 times or 16 times. And it's not. It's up here. Equity market is wrong and the bond market is right. And we sort of took issue with that. I'm an equity person. I don't assume that the bond market is always smarter than the equity market. I think maybe sometimes one thing can be sniffing out something that the other can't figure out. But we sort of challenged that idea of just looking, in this post-GFC world. And I had been tinkering around with a model. We now publish it regularly in the weekly, but it was based on trailing PE data that goes back to the 60s. And I just happened to have a time series that goes that far back. I can't get forward PE data that far back, but I just spent a lot of time trying to figure out what macro variables explain these movements in the PE. And after sort of a lot of testing, I got a lot of inspiration from talking to investors about what they thought should be driving the PE. We found that inflation, if you look at PCE, very, very inversely correlated with that trailing PE. Interest rates are as well. If you look at Fed funds, if you look at 10-year yields. And I don't remember why I even did this, but maybe it relates back to that discussion we had about the GFC changed some relationships. I put in the Excel spreadsheet just different decades, and I started looking at the correlations by decade. And I realized that in the 70s, when we had this really, really intense inflationary environment, that inflation did a bit more to explain the movement in PEs than interest rates did. And if you look at that data post-COVID, when again, inflation has been the main thing we're all focused on and kind of driving all other calls, Guess what? Inflation has been a more powerful driver of movements in PEs than interest rates. And it was just really fascinating to sort of look at that data. So we've looked at that and sort of married it up with the sentiment. I mean, if inflation is driving the sentiment, if Fed narratives are driving the sentiment, and they're also driving inflation, it's just sort of an interesting synchronicity, I would say, between the two. And really, we've gotten a little bit frustrated. People really seem to be just focusing on the Fed call, the inflation call. And while it's not necessarily the most fun focus for me in meetings, it does make sense when you go through and look at the data and understand that this is driving everything. And guess what? There have been some prior periods in history where this has driven everything. So again, if you're just looking at the post-GFC playbook, I think you're really missing what's going on right now.
So given all that, do you think the market's fairly valued today?
We have the pleasure as strategists of trying to guess where the S&P 500 is going to end up on December 31st of any given year. And that at least is how the job has always been explained to me. And we can debate whether or not that's the right way to do it. But that is really kind of how we think about it, as opposed to just a high water mark or a low water mark that might occur during the year. So we're at 5,300 right now. That's my target. And as we're speaking here today, that's basically where the market's been hovering, plus or minus a few points. And what we've been telling investors over the past week is we certainly do not feel bearish. We really don't feel like we belong in that bearish camp. I think the bearish camp is looking for a recession that essentially already happened in 2022. And we've basically been in a very misunderstood recovery over the past kind of year and a half or so. And as we think about the math around the market, and I had one client who once told me, he said, Lori, we love you because you're all about the math. So we really are driven by the math. We don't do the narrative first and then come up with the charts to prove our point. I really am against that kind of strategy work, to be honest. But the math is really telling me that we're fairly valued right now. And so if we are going to justify a materially higher move in the market, we need new information. What could that new information be? It could potentially be inflation moderating more than we've anticipated and that we've baked into our models, getting more Fed cuts than what the consensus is currently assuming. Our model on valuation basically leverages the current consensus views on inflation, interest rates, and the Fed. And it's baking in about 2 cuts right now. So are we going to get something more than that? We're baking in, I think, PCE going to 2.6 at the end of the year. Are we going to get something more significant than that kind of deterioration? The other thing we've said, and we put that out in our weekly this week, was we don't have all the answers on this yet. But at some point, this market is going to stop thinking about 2024 and transition to 2025. And right now, there still seem to be a lot of clouds and a lot of fog in sort of the investor outlook. And that's not to say that those are necessarily storm clouds, that there's something nasty around the bend, but it is just a little bit hard to see what 2025 really looks like when you've got an election, you've got uncertainty on the Fed, and we've also got GDP forecasts that are sitting down at below trend type levels for next year.
All right, we're sitting here less than 6 months from the election. I'm watching the betting markets for the changes in who seems like they're going to win. What are you thinking about the upcoming election and how the different outcomes may impact financial markets?
I won't make any predictions. I joke, if my dad were still with us, he would be very proud. I'm getting to my political science degree. I'm getting to put it to work every day. He did not think that it was a very useful thing to study. I actually used to carry around my Politics 101 book that I got in Larry Sabado's class at UVA. I used to actually keep that in my office. I've lost it. I don't know where it went, but I've used that a lot over the years. And a lot of things I learned from that class, to be honest. But look, I think the reality is that if you take a step back, stocks tend to go up under any combination of political leadership. We've got some good data in this. And there are certain scenarios where it goes up a little bit more than others. It's hard to argue that that's because of the political leadership or some quirks of things that were going on in the economy at that point in time. But generally, stocks find a way to price in change. They don't necessarily like change and uncertainty at the beginning. And so if you look at the beginning of a presidential election year, you typically see some sort of sell-off during the first half. And you tend to rally back over the summer. That's usually when the conventions are happening. You have the candidates settled. You know what the policy agendas are more or less going to look like. And you tend to see the market rally back and then get a little bit choppy around the election and then have a relief rally kind of once it's all over. Now, is it necessarily going to go that way this year? I don't know. This is sort of an unusual election. We've got 2, essential incumbents that voters are pretty familiar with already. And there's also, I think some opacity in terms of the policy that might come out. I think that's something U.S. investors are struggling with a little bit about what would either of these candidates actually do that the stock market would really kind of dig its teeth into. So we actually did a survey of our analysts back in April, and we went to all of them and we said, look, if you get a Democratic sweep or Republican sweep, if you get Trump or Biden winning with a split Congress, what's the impact on the outlook for your industry in terms of information available to you today and policies specific to your industry? So if you're an energy analyst, we don't want you thinking about healthcare policy, for example. And I have seen in the past some analysts, at other shops I've worked at have tried to do that. But the reality is that I say in my meetings, we have these pretty color-coded charts. There's a lot of gray on the page. So what's the gray? The gray is the neutral or NA category. We gave them an option to say this isn't going to have a major impact on the outlook for our industry. If you look at the Republican sweep scenario, that gathers the most bulls, but it's only about 48%. And a lot of those, we give people the option of very bullish or bullish. And so most of those are in the bullish category as opposed to the very bullish. There are very few people picking an extreme position in any scenario that we gave them. The Democratic sweep generally elicits the fewest bulls, but even there, the bears only number about 17% of the total. And it tends to be sectors that I think would be top of mind, areas like energy, healthcare, that tend to have the most extreme views from our analysts in terms of whether there will be bullish or bearish scenarios. But even then, they tend to be in what we call the +1 or -1 camp. So they're not really looking for very bullish or very bearish outcomes. So I don't think there's necessarily a lot to do if I'm a trader, if I'm trying to make these big sector calls on this short-term event. And if anything, I'm sort of hearing from U.S. investors over the last month or two, they're not looking to really make big trades right now. I think they're trying to be aware of the event, aware of the implications it might have for their portfolio, but I don't think there's an itch to really do a lot. Non-U.S. investors is very different. They've been talking about this since last summer. You mentioned the betting markets. They were the ones that first alerted me to the fact that RFK Jr. was starting to make a move in some of these markets. So non-U.S. investors very, very focused on it, and maybe perhaps a little bit more focused on some of the foreign policy differentials between the candidates.
So in a previous life, you covered small cap stocks. What's your take on the setup for U.S. small caps today?
We keep seeing signs of life and they're extinguished very quickly, is the honest answer. And I still spend a lot of time talking to small cap portfolio managers. I spent 7 years of my career with that as my focus. It's still probably about 25% of what we do today. And it sort of pains me. I always describe the small caps as my first professional child. They're so cheap relative to large caps. They do seem to be unfairly penalized for a lot of things. The balance sheet discussion, right? In this era of rising interest rates, there's been a lot of concern about small cap balance sheets. We've got a lot of data showing, yes, they don't look as good as large caps, but they're much, much better, much cleaner than what we've seen in past cycles. So we think they've gotten a little bit unfairly beaten up on some of these Fed fears. But the reality is that if we think about the concept of conflicting cross currents hitting the stock market broadly, I think that there are particularly strong conflicting cross currents hitting the small cap space right now. In small caps' favor, yes, they're very cheap relative to large. If you look at positioning on the CFTC data, that's another sentiment indicator we look at weekly that really gives you more of a flavor of the institutional community, just positioning in U.S. equity futures and different contracts and broadly. That looks terrible for the broader market, terrible for the S&P 500, very, very stretched around past highs, but it's actually down around SVB lows for the Russell 2000 futures. So they look a bit under-owned or oversold right now. I think we've also had an interesting economic tailwind develop. So we've seen GDP forecasts in the U.S. rise to about 2.4% now as we speak for 2024. That's right on the cusp of average. Average is about 2.5%, 2.6%. And traditionally, when you see GDP perk up above average, small caps, cyclicals, value tend to outperform large caps, growth, and defensive areas of the market. So underestimating how strong the U.S. economy was and ratcheting up those expectations, that's really good for the small caps as well. So what are the problems? Despite everything I just told you about the balance sheets not being as bad as they've been in the past, they still don't look good versus large, and there's still a perception problem. It doesn't matter how many charts I show people of how much improvement the small caps have seen on the balance sheet data, they still get beaten up when Fed fears rise. And what we've also seen is they tend to really outperform after Fed easing starts, not before it. So you really need to get those cuts started for the small caps to start going. I think the other thing we've seen is that small caps, as much as I like the relative valuations versus large, they're basically back to their average right now if you just look at a forward PE. So that forward PE is about 15.2, and last time I updated my chart, it was sitting at 15.19. So we keep seeing these situations where small cap PEs will trade down to like 11 times, 13 times, 14 times, catch a little bit of a bid, bottom versus large. Everyone gets excited about the Fed again. They perk back up, and then we get back to the average. Party's over, Fed's narrative starts to disappoint, and we push them back down. So they're defending the relative low. They're really, really fighting back, and it's really impressive, but they just can't get the momentum going. And I don't think they really will until, one, we really break above average on GDP forecasts, or two, we just get the Fed cuts started.
What about value versus growth? Do you spend time on that as well?
It's interesting, partially, I think, because I did spend so long as a small cap strategist and sort of lived in Russell land. We never really got to the point where we said, this is what we think is value, this is what we think is growth. Most of the managers I work with, they have benchmarks. It doesn't matter what I think growth is or what I think value is. They're stuck benchmarking to the Russell 2000 growth or the Russell 1000 growth, or maybe one of the mid-cap sleeves of that. So we tend to just defer to those indexes. I do think generally, if you look at sector composition, it sort of dovetails with our reality, right? Which is that the sort of big tech complex, and that's spread around three sectors now: tech, comm services, consumer discretionary, and the Russell 1000. That ends up kind of being your growth bucket. So when we sort the sectors, that's what we'll generally call growth. If you think about value, cyclicality, we tend to put materials, energy, industrials in those. And also the financials are an obvious one. And then defensives, I think actually are a little bit tricky to define these days, but generally staples, utilities, sometimes we put in REITs, sometimes we don't. Healthcare, I think, is another one that you can debate a bit. I will tell you, though, it's an interesting question, what belongs in these different buckets, because on the industrial sector, it's got a crazy high PE right now. It's like a 3 standard deviation event on our chart on both like an absolute and a relative multiple. And when we're looking at medians, we're not even looking at cap-weighted multiples. So that's your typical stock. And it's as bad as the tech sector. It's just an interesting debate because of the theme of reshoring, of deglobalization. We think these are big mega themes that are in place post-COVID, and they're not going away anytime soon. Is industrials becoming more of a growth sector? Is it going to start trading at more of a growth type multiple? Is it even valid to go back and compare the PE today to the PE over the last 20 years? If it's changing its stripes and moving from more of a cyclical to more of a growth-oriented area, we may be misjudging the valuations and what's really truly expensive in that area. So I think those are really interesting conversations. And when we think about how that translates into what you do with a portfolio, we say, look, we acknowledge the valuations look pricey, but we're not going to go underweight because of that. It may be tough to take an overweight position with that kind of sticker shock, but we're at least going to stick with sort of a neutral or a market weight position in our portfolio.
You pointed out that earnings per share yield is nearly at parity with bond yields. Is that bearish, bullish for stocks? What's it mean?
I will say I spend most of my days talking to portfolio managers who are equity people. I do have some clients in the kind of multi-asset crowd, but that's not predominantly who we're trying to solve the equations for, if that makes sense. If we rewind to 2023, there were a lot of what I would say bad bearish arguments floating around. And I felt like I'm an old high school debater, and I felt like I was constantly debating some of my peers by proxy. And one of the bearish arguments that was circulating, because I wouldn't normally spend a lot of time on this, to be honest, but it just kept getting kind of thrown at me meeting after meeting, was this idea of the competition of bonds and the earnings yield gap having collapsed. And that had to be bearish for equities. And we sort of looked at the data and we just said, if you do a back test, and we were looking at forward PEs, that's what's based in the model. I have that data back to the late 80s. We just did a very simple earnings yield gap, looking at the forward PE, flipping it and Xing out the bond yield. And we said, what happens when the earnings yield gap gets to be this narrow, the similar range that we were in at that point in time? And we went back and we did a back test and we said, guess what? It was pretty close to that throughout much of the 90s, and stocks did just fine. And so, it was a relative gauge that was being used to make an argument about absolute returns in the equity market. And again, I'm not the multi-asset strategist. So I'm not trying to make the stock versus bond call and which one is going to be better. But we looked at it from the perspective of just because one thing looks a little bit more appealing doesn't mean the other thing has to get trashed. That was really the argument we felt like was being presented and didn't make a lot of logical sense. And then when you actually went back and looked at the data bore that out, that two things could be appealing at the same time. And in fact, if you go back and look at the Federal Reserve flow of funds data, they have some really great data on household allocations as a percentage of financial assets to things like debt and equities and cash. And we went back and looked at that data, and I think it was actually throughout like most of the 80s and the early 90s that allocations to both bonds and equities went up at the same time. And so the idea that one has to steal from the other, I understand the logical appeal, but we just didn't think that that was necessarily borne out by history. And I would say that arguments died down. It was something we spent a lot of time talking about last year. And I think, frankly, the fact that we came into 2024 and in the first quarter, we saw tremendous money going into bond funds and we saw tremendous money going into equity funds. And guess what? We also saw a lot of money going into money market funds that I think investors kind of quieted down a little bit because ultimately this would manifest in flows. And the flows just bore out the idea that there's plenty of opportunity to go around and kind of benefit all these different things. Now people look at that cash sitting in money market funds as a source of cash on the sidelines that may potentially come back into equities at some point. Now, it is earning a lot, just given where interest rates are. So we might need to see the Fed ease up and interest rates to come down a little bit to admittedly unlock some of that. But I think we've just entered into a different phase this year where people understand it's a little bit more complicated than we were led to believe last year.
You've got some great charts on the concentration of the large names in the S&P 500. Do you think that'll continue or there'll be a catch-up trade with other names?
So I would say we're talking a lot about this rotation argument in the market, so growth versus value. And it's funny, that is a debate that sometimes people love to talk about and sometimes people hate to talk about because at the end of the day, a lot of my managers, they're growth investors, they're value investors. They're not really going to necessarily switch between the two. But the thing we've been talking about is if you look at the concentration in the market, and I think there was a lot of concern that we had sort of reached some dangerous tipping point last year. We don't really see that in the data. We see concentration spike at periods when markets are nervous. And sometimes that happens after a crisis, before a crisis, or the middle of a crisis. There's really no rhyme or reason if you go back and look at it. All it tells you really is that there's some nervousness in the market. Now, we have been looking at PE data for the top 10 names in the market versus the rest of the S&P 500. And we've got a fascinating chart that shows if you look at that top 10 cohort, and we rebalance it over time, it's not always the Mag 7, but right now it's got the Mag 7 plus a few other things. You've been trading, depending on which day we update the data, high 20s kind of multiple, right? 25, 26, 27, somewhere in there. And it's kind of bumping up against the pre-COVID ceiling. And you're just not really getting a lot of multiple expansion in there. It's sort of stalling out. The rest of the market's trading around 16 times on a forward PE, so a little bit above average, nowhere near past peaks, and a level that many people would tell you is quite reasonable. I think there's a catch-up trade in the latter part, and that's often what we see coming out of difficult periods is something runs hardest off the bottom, takes a little bit of a pause, and the other thing catches up. So the question is, why would that other thing, what would cause that other thing to catch up right now? And I think it goes back to the idea of earnings growth. So we have another chart that we show that looks at the Mag 7 names, and we get this data from Bloomberg. This is not my data, but they do a beautiful job compiling it. And they're showing you basically you had about 35% earnings growth in the Mag 7 bucket last year if you treat it as one individual stock. And that growth rate is expected to decelerate this year and then decelerate again next year, I think, to around 14, 15%, something like that. Rest of the market was negative last year, expected to retrace into positive territory this year. And then guess what? Get into the low teens in 2025. So you've got this enormous valuation gap on the PE, and you've got a shrinking gap on earnings growth expectations. And so I see a couple of things in that data is number one, when people try to tell me the market has been silly, that we've resembled that tech bubble period when things got out of hand and valuations, were high for bad reasons, I don't buy it. I think this has been a very rational market. The multiple chase the earnings growth. And it's sort of at those lofty levels because of that earnings growth differential we've seen recently. But I also think things are changing. And I don't think investors are really going to play that premium multiple anymore for earnings growth that is less advantageous. I think it is very rational. I think it is very Darwinistic. And I think it's frankly very healthy. And I see investors as I go out on the road, talk to people, it's felt like the last 6 months that Mag 7 bucket has shrunk. If your earnings growth isn't holding muster, if there's some sort of problem in your growth story, you're getting kicked out of the bucket. That's what we want to see. We want investors to be that shrewd and that discerning.
In the last cycle, margins was something that everyone was talking about. There's been talk about whether or not they're going to remain higher forever or mean revert back to long period averages. Do you got any insights based on the recent earnings season?
It's something we think quite a lot about. I'm not sure that we have the magic bullet answer to where they're going. I will tell you that when I look at my earnings model for the S&P 500, it's basically an income statement for the S&P, and we have 5 main line items. One of those is revenues, one of those is margins, one of those is buybacks, one of those is taxes, and the other is interest expense relative to sales. And if I think about those 5 things, the one that gives me the most trouble is the margin line. I find revenues, you have to have your forward-looking macro assumptions right, but the modeling we've done, the formula, the math is pretty easy. Interest expense versus sales, I would say that math is pretty easy too. Taxes and buybacks are straight up guesses. We sort of look at how things are trending. We frankly hold taxes flat year over year. We've noticed some weird things like tax rates are going up in terms of what companies are paying, but it's not a big point of discussion with investors, just sort of a quirk in the data. Margins, we sort of gave up trying to model it out with macro variables and have been putting in sort of flat margins. You could make an argument, you could make different assumptions, but that's what we've done in our model for now. And we're at 237 on earnings for the year. The bottom-up consensus is tracking about 245. And when I look at my model versus consensus, I think that is the big difference. And if I look at the consensus data, it's baking in margin expansion for every sector over the next year or so. So I think that is the big differentiating point. And I'll tell you what we struggle with on margins is that any kind of qualitative or quantitative data point that's explained margins in the past and those trends doesn't seem to be working very well recently. And they keep surprising to the upside. So there's something that's changed. And we've thought a lot about why is the math not working? What has changed? What are these upward pressures on margins? And one of those is the tech sector and the composition of the market. There's just structurally higher margins there. That composition of the market is a little bit different than it's been in the past. So that's one thing. But again, margin expansion is being baked in for most sectors next year. So what's explaining that? And that's where I would say we lean on kind of art more than science and qualitative inputs more than quantitative inputs. We read transcripts on my team. There's nothing that can replace hard work at the end of the day and attention to detail. And so my associates and I divide up the earnings call transcripts by sector. They're frankly doing more of the reading right now than I am because I've been traveling a lot. We kind of have our favorite companies that we read. We watch stock price reactions and read the ones that move the most. I'm not going to sit here and tell you read every company in the S&P 500. We don't. We speed read and we read what we think is most helpful and, what's reacting the most. But we've done this for a number of years now. And I feel like I'm just coming to the conclusion that companies are just really, really good now at managing through crises. And it's not even that I saw this start during COVID. We really saw this begin around the trade war back in 2018. And that was really just a big unforeseen challenge that was thrown at companies that year. They really had to react. They ended up managing through it, I think, a little bit better than expected. But then we got to COVID, which was an even bigger challenge to throw at them. We had the inflation spike. We had supply chains. We had labor shortages. We've now had geopolitical conflicts to work around in recent years. And the tone of companies, if you really, and I'm not listening to the calls, I'm reading them, but the companies have really just become very confident in their ability to manage around these challenges. And I really noticed this after the regional banking crisis last year. We were reading through, I think it was like 8Ks and press releases, and my banks analysts were sort of taking the lead on this crisis. I was letting them do their thing. And I was spending a lot of time just reading, and I saw a number of companies that even went back and referred to the financial crisis and how they managed through that period and lessons that they brought to the table. And so I think we've just had a wealth of institutional knowledge and competence that's built. Layer on that we have tools, automation, all these new software tools. We don't even have to get into AI. That's still very early days. But all of these technological tools have really just armed these companies to go in and work around these challenges. And I think they just have a sense that they can work through things, and they're constantly finding costs to suck out and efficiencies to add in. And that's translating into margins. It's really just a thing of beauty to watch, to be honest.
Anything else on the brain we haven't talked about today?
I think that the concept of uneven recoveries is something we've been thinking about a lot lately. And I was looking at some data on consumer confidence at the beginning of the year, and RBC's four main coverage regions on the equity side are US, Canada, Europe, and Australia. So I was looking at consumer confidence metrics for those different regions. And it was just really interesting to me because the University of Michigan Consumer Sentiment Indicator went down to levels worse than a typical recession in 2022. I stumbled across a pan-European consumer confidence indicator, and it also went down to recession-type levels in 2022. And actually, the chart looks broken, but I think it's the war that really sent it down very sharply in a hurry. And then we looked at, and you've been seeing recovery in those indicators since. It's not that the levels are off the chart, but the trend is in the right direction. If you look at Australia and Canada, they took much longer to sort of hit those lows. They've been sort of stuck around those lows. If I look at Australia as sort of a proxy for what's going on in that part of the world, it just struck me that the US feels like that we've just embarked on some sort of recovery a bit earlier than other regions. And I think that's helped the US just in terms of being a safe place to stash money. What I've noticed in recent earnings calls is companies are much more balanced. And these are S&P 500 US-based companies, but their conversations about China are much more balanced than what we saw throughout the past year. So we saw some companies in this last reporting season say the worst is behind us in China. Pressures are moderating. That wasn't the universal view, but for every company that said things aren't great, I felt like I found a company that said, things are okay, or maybe getting a bit steadier. And that contrast with really over the last year, it was just negative, 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 disappointing recovery. Things aren't going well. US investors are listening to this, but so are global investors. If things are starting to stabilize and embark on a recovery in that part of the world, that is where I do think you have to pay attention to flows. So it's not just equity bond, it's also geography within equities. And so if we start to see, maybe that bond pressure come in at the same time that some European pressure comes in or some non-US pressure, that's actually, I think, a bigger risk for equities because I do think the flows into the US have offset some of that pressure you might have seen from the asset allocation shift. And I'll just round that out by saying if you look at European equity flows on the EPFR data, they're stabilizing. They're not positive yet, but they're not getting worse and they're getting a little bit better at the margin. We've seen similar things in Australia and Canada where some of these non-US markets, you're starting to see some early indications of stabilization or a turn.
So what's your favorite indicator? Any fun, weird, different ones to look at?
I sort of have my arsenal, and if anybody reads my weekly, I talk about the same 10 charts. I would say throughout the different weeks. And, those are things like AAII, our valuation models, pretty unique. I love small versus large. It's just a sentiment indicator for the Fed right now. But I would say the one that's maybe a little bit off the beaten path is just looking at the misery index, which is just unemployment versus the inflation rate. And to me, I stumbled across this when I was doing some work on the election, and I saw someone in the political world reference this chart. And they were talking about sort of the low levels of misery. And I went back and looked at it and I said, well, if you go back and you look at 2022, misery spiked. Things may be better now, but in the very, very recent past, people have felt pretty miserable and was taking the contrary view, let's just say, of what this person was trying to argue. It got me thinking a lot about that 2022 period. I know we talked about this a little bit earlier, but stock market pricing, 25% drawdown in the S&P, consistent with a recession. A recession is typically 27%. AAII, we didn't talk about this earlier on this particular data point, but in 2022, it went down to GFC lows. It was as bad as the great financial crisis. And if you looked at the University of Michigan Consumer Sentiment Indicator, it was as bad or worse than a typical recession. So we all felt all these sentiment indicators. The stock market was telling us we were having a recession, that we felt as bad as a recession. That misery index was the key for me because it said, okay, we didn't call it a recession because the unemployment rate didn't move up. But guess what? The move up in inflation more than offset that. And people felt as bad as they typically do in a recession because of the inflation spike. To me, that was the biggest aha moment because it let me make sense of all those sentiment indicators. Russell 2000 PE hit 11.3 times in the middle of June of 2022. That is a typical recession low. Why are we not calling it a recession? Because the labor market didn't fall apart. I think GDP was actually negative that year. But if you sort of understand that maybe this was pretty darn close, it makes a whole lot of things that happened make a lot more sense since then, that we've just been in the middle of this very, very strange recovery. So to me, that's just a good reminder of Don't just look at, sort of these classical definitions of recession. Look at the bigger picture and think about how people are feeling and why. I'll give you another one that my derivative strategist, Amy Wu Silverman, who just does fantastic work, the one that she turned me on to was the TDEX index, just looking at gauges of tail risk. And I do like falling down. We've got a bunch of these in our weekly where we just look at all these different volatility gauges. The move one is another fun one for me. And that one I noticed is still much higher than equity volatility. And it's in this weird elevated range, but it's actually come down to the low end of that elevated range. So that one, I've been noodling over that one a little bit lately.
All right. When you sit down at a table, having a coffee, a beer or something, glass of wine, chat with a bunch of your friends, professionals in your field, what belief do you hold that if you said out loud, 75% of your peers would disagree with?
I think it goes back to that valuation model. We're looking at trailing PEs, not forward PEs. But there is just a deep-seated belief out there. The market should be trading at a mid-teen multiple. So when I show people that chart on the top 10 versus the rest of the market, 28 times versus 16 times, people love that one on the rest of the market that shows it at 16 times. And I like that. I like that it makes people feel good. And I like that catch-up trade thesis. But I think that on a trailing basis, we can sustain multiples in the low 20s. And people, I really have to walk them through the model. I have to walk them through the math. It's a very simple regression model. It takes the data on PCE, Fed funds, and inflation going back to 1962. So we're baking in the 70s. And it's just a very simple Excel regression model. And if you put in those current assumptions or even some of my stress tests, my tests right now range from like 21.8 times at the top, which is the current consensus assumptions, with some decent moderation in inflation rates, to a 19.1 multiple if I bake in a couple more hikes and inflation at 3.5% instead of 2.5% on the PCE. So even, in my stress scenario, I'm getting you to 19 times, and that actually can damage the market, by the way. That can take you to 4,500 if you walk through the math, leveraging the earnings forecasts. But really, people are just stuck on this idea of 15 and 16 times. And all I can tell people is we've done the math. It's a different flavor of the PE. And it's just math, by the way. It's weird how certain people can just get really offended by this idea. You do sort of just have to say, I'm going to look at a trailing number instead of forward number. And guess what? Those tend to be higher. And what I tell people is, look, I've been using this model for a year and a half. I came to it with open eyes, no preconceived notions about what a PE multiple should look like, and that forward is better than trailing. And guess what? I did the math. I found something interesting. And guess what? This model worked last year. It was pointing to you to 4,700 to 4,800 on the S&P. I actually went back and looked at all of the updates starting in June when we really started focusing on it. And it kept me out of trouble last year. It kept me from being too bearish. And that makes people pay attention when I say, you know what, this actually worked really well last year. I did not listen to it enough. My target was way too low. But, shame on me. I should have listened to the model a little bit more.
All right. When you look back at the arc of your career, what's been your most memorable investment?
I think we're all products of our experience. And I do think that some of these big breaks in the market, I don't want to say trauma, but they can affect our decision-making, good or bad, for a long time. And I think for me, starting in 2000, seeing the implosion of the tech bubble, that kept me too negative on tech for a long time. I think we recognize that and we try to compensate for that, but I do think it negatively impaired my thinking on that sector for a long time. And I do see some people making the sort of same mistake that sort of came to their formative years were around the GFC. And I do think that that shocked a lot of people regarding specifically, say, the banks, say, housing, waiting constantly for the next shoe to drop. One of the things that's been coming up in my meetings, and this has been on commercial real estate, which I am certainly not an expert in. I'm a generalist. I'm taking in a lot of information. My thoughts are very higher level on this. But I say, look, I think from everything I've seen, from going to our financials conferences, listening to the banks, reading through their transcripts, looking for every detail I can find that my peers and public companies are saying about this issue, I think the regulations have really worked. I think for a long time post-GFC, there was a lot of consternation about the financial sector and the idea this sector was being so regulated it couldn't grow anymore. And a lot of investors kind of stopped looking at it. But I think as we have gone through recent years and recent challenges, we're really seeing the benefit of having put in some regulations that were pretty strict, to be honest. And so one of my fellow analysts and I, we like to say the stress tests have worked. We didn't like them at the time. They have restrained some things that I think investors would have preferred to not be restrained. But the reality is, I think we're all sort of looking for this commercial real estate shoe to drop, and it hasn't. And you've had some issues here and there, right? But in general, the financial system has held up really, really well. And so I think it's been tough, I think, for people who sort of, again, came of age during that GFC period to really understand that things are a little bit different this time, and we're not going to have the same bomb go off that did before.
Lori, this has been a lot of fun. For people who want to follow you, what's the best place to go?
If you go to Apple Podcasts or Spotify, you can get our podcast for free. It's basically, sort of a synopsis. Maybe we don't cover every single thing, but kind of the highlights from the weekly report that we put out, which is called the Weekly Pulse. If you do business with RBC, you can sign up for the email list, but you'll have to go to sort of your RBC representative to get that. But I think the podcast is really sort of a great way to keep up with kind of our latest thoughts. And it's pretty much every week. Sometimes I go on vacation and have a guest host from one of our other analysts, but mostly it's just me.
Lori, thanks so much for joining us today.
Thanks for having me. This was a lot of fun.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.